Hello, everyone. Good evening. This is Waris Karim again with Managerial Accounting. Tonight, we are going to talk about master budget. This belongs to chapter 8 of Horngren textbook, chapter 8 of Garrison textbook and chapter 7 of Horngren textbook. So we are using, of course, you know that we've been using Garrison Norrin Brewer textbook, this one. So chapter 8 is master budget. All right, so master budget or budgeting in general is one of the most important tasks of a managerial accounting, or most important task of managers, because without a budget, you don't have a plan. And whether there is an informal budget or a formal budget, a written one or unwritten one, I think all of us have a budget, because without a budget, you cannot plan or embark on an activity. So by budget, we think of a plan. And when a plan is written down in numerical, in dollar terms, in numerical terms, then we call it a budget. So a budget is basically an expression, a written expression of a plan, a financial expression of a plan. So a plan detailed in financial terms is called a budget. Otherwise, all budgets are actually plans, but not all plans are budgets. You see, all plans are not budgets, but all budgets are plans. So budget is a quantitative expression of a plan. And we know that planning is the first job, the first task of management. Remember, planning, organizing, budgeting, coordinating, planning, organizing, coordinating, controlling, motivating. So those are major management functions. So within planning, we have budgeting. All right. So in managerial accounting, master budget includes all the operational and financial budgets. So it's basically a combination of all the budgets that you could have, starting with the top line of an income statement, what that is, sales. So start with the sales budget, then you go on and do a production budget if it's a manufacturing company, or if it's not a manufacturing company, if it's a merchandising company, then we do materials or finished goods purchase budget, or simply purchase budget. But for manufacturers, we have the sales budget, the production budget, the materials or raw materials purchase budget, then the labor budget, the manufacturing overhead budget, and operating expenses budget like selling and distribution and administrative expense budgets. So by then we have a cost of goods sold budget, or a budget of all manufacturing costs. We have an income statement, a budgeted income statement, and a budgeted balance sheet. And finally, a cash budget. So according to this book, this chapter, a budget includes 10 different budgets. So take a look. There are 10 budgets here. Sales budget is number one. Purchase budget, production budget. Then raw materials purchase budget, direct materials, labor, manufacturing overhead. Those direct labor, manufacturing overhead, cost of goods sold, selling and distribution, administrative expense, cash budget, then a budgeted income statement and a budgeted balance sheet. All right. So these are our 10 components of the master budget. So master budget is actually a comprehensive budget. It has everything, all the budgets. If you have the master budget, you will find all the budgets. All right. So how does a budget, why budgeting? I don't want to get into too much theory here, because this presentation is to aid my students at Alabama A&M University, the managerial accounting students, the accounting 219 people, 219 students, to complete their assignments. That test is just around the corner, the final exam. So, but for everyone else, I want to keep it as general as possible. At the end of the second half of this presentation is going to involve some problem solving based on the assignments that we set from the Garrison textbook on McGraw-Hill Connect. But apart from that, or even including that, everything is going to be useful to everyone who is interested in master budget or budgeting in general. But especially those who'd like to know how a budget is prepared and how the budget lines, how the budget mechanics work, what are the formulas embedded in a budget. Because the budget is basically a totally an interconnected set of activities. Okay, a master budget actually connects everything that an organization does. All right. So how does it help? What I find is that, and most managerial accountants agree, that budget is one of the two most potent weapons or instruments of financial control or management control system. And in depth, when you go to higher level managerial accounting, you're going to talk about or think of management control system, or MCS. So the two major instruments or the two major tools that managers use to control organizational activities, to control finances, to control production, to control employees, to control the overall operation of the organization are: number one is budget, and number two is called variance analysis. So budget sets the standards, and once you have the standards, we can calculate, compute all the variances. There are so many variances, and based on those variance analyses, we can then identify the weak links, identify the areas that need our attention, identify the areas that need appreciation, that deserve appreciation, and identifies areas that are going to be that would like to promote, that would like to pump in more money, more resources, or the areas that we'd like to nudge a little bit. All right. So budget gives you that foundation based on which you can carry on and do a variance analysis or performance appraisal. Because unless you have a budget, you have nothing to compare. So budget is the standard. Budget is the standard, and budget also can be inspirational. It inspires people, because once you have a budget, it's like students having a routine. We insist on little kids to have a daily routine, because if you have a routine, you have a self-imposed standard, you have a self-imposed discipline, because you promised you're going to start working on certain things at 8 o'clock in the morning or 9 o'clock in the morning, and then it binds you. So a budget actually binds the organization's resources, and especially organizations, the people, their departments, onto certain track. So it has a binding ability. It makes us feel obliged. So it's also an accountability instrument. If you have a budget, you can make people accountable to or against those budgets. Budget can also be a motivational tool, because if you prepare the budget, having everybody on board, that's the budgeting process. So the people, or the activities, the efforts, the chemistry behind budgeting could be used in to create that positive energy. Because when you plan the activities, like the value of consultation, the value of so-called due process, like talking to constituents before you set the plan, before you lay out the plan. So if you engage everybody, right from at least the mid-level managers or different unit managers, and then the unit managers will be talking to their subordinates and their colleagues. So by doing this, you can essentially combine and kind of connect everybody, all the units, all the organizations, all the departments, all the divisions, onto the organizational goal. But the goal is translated into those different targets, and the targets are set out in the budgets. All right. So that's all the theory you have. I plan to now go on directly to the different operational budgets or different budget activities. So the first budget, actually, just one moment before we get to the formulas, I'd like us to take a look at this slide. So take a look. This is an overview of master budget. You can see it's a slide from the Garrison textbook, publisher designed slide. You can see the sales budget at the top. So that is the first budget. That is the goal. Because unless there is sales, there's no production. We don't need to buy anything if we don't want to sell. So selling is the core activity of an organization. You survive, you exist to sell something. They say that everybody sells something. So you're all salespeople. All right. So sales budget is number one. Then to satisfy or to support the sales budget, we need to have a production budget. Because unless you produce, what are you going to sell? Well, to produce, what do you need? To produce, we need material, labor, and overhead. So these three are the three major elements of production. Materials, so materials have to be there. So unless we manufacture materials as well, would be procuring or purchasing materials. So that's outsourced. We buy materials, so there must be a materials purchase budget or materials acquisition or requisition budget, and then there is labor budget. We need to know how many hours of labor, or how many thousands of hours of how many people we need to hire, and then the manufacturing overhead, the variable overhead, the fixed overhead, all the manufacturing overheads like equipment, their depreciation, fixed supervision, fixed energy, fixed buildings, fixed space costs, rental costs, salaries. So all the manufacturing people's, their overhead and manufacturing facilities, their budget, and then it has to be supported by the two operating expense components, operated by two operating expenses. We don't exclude, manufacturing is of course part of our operations, but I'm going to use the financial accounting or financial statement, income statement definition of operating expenses, and there are two major categories of operating expenses there. One is the selling and distribution, so we'd have to have a selling and distribution budget, and the second one is administrative expense, so we'll have to have an administrative expense budget. So once you have everything, all the major activities that would lead to our eventual sales, then we'd have an income statement. Now, notice one thing, that we don't have a budget for extraordinary activities. We don't have a budget for an earthquake. We don't have a budget for any non-routine activities. But core and non-core, you'd have to have a budget, whether it's core activity or non-core activity, as long as it's routine activity. But if you don't have a non-routine, what I mean to say is that you cannot plan for an accident. Then it's not an accident anymore. You cannot plan for an extraordinary event, then it's not an extraordinary event anymore if you could plan for it. So we don't have a budget for those extraordinary gains or losses, or earthquakes or fire loss or accidental damage and those. But the reason I say that is that those items are also eventually, if that happens, then they're also included in our income statement. So we'll have a budgeted income statement and a budgeted balance sheet, but also we'll have a cash budget. So cash budget it doesn't fit in the income statement or in the balance sheet, but cash budget is a standalone by and of itself a budget of great importance. It's one of the best budgets, the best budgeting skills that you could have, cash budget. All right. So this is our scheme. All these budgets, you're going to learn how to make all these budgets and stuff. All right. So that's the budget. Now, starting with the sales budget. So this is our sales budget. Take a look. Your sales is basically, I express it as PQ, your price per unit and quantity or number of units of that particular item of the product that you'd like to sell. All right, so let's say you have just one product, say iPhones, and you'd like to sell, say, 1 million units of iPhone 12. So if each one, and let's assume that there's only one type, one model that you manufactured, so $1,250 or $1,000, so 1 million times 1,000, so that would be $1 billion of sales budget. Simple. We would like to sell, so today is the 2nd of December of 2020. So if we are budgeting for 2021, although 2020 December would be too late to budget for 2021, I think you'd have had the budget, it is 6 to 9 months ahead, or sometimes even 1 year ahead. But don't make it too far ahead, then it would be an unrealistic budget, because you'd need to have a sense of the market, a sense of the production facilities, a sense of the raw materials and other linked items like the supply chain and everything. So these are so dynamically changing. We live in such a fast moving world that budgeting too far ahead is risky. It's also risky. But budgeting too late into the season is of course risky, because then you do not have time to have a realistic plan, because budget has to be a very well thought out plan. You need to discuss with everyone, and you also need to understand the market and analyze the market budgets before budgeting. There are a lot of other activities that go on. Anyway, so sales budget for next 2021. Let's say we would like to sell 1 million units of iPhone 12, and each one is going to be sold at $1,000. So $1 billion worth of sales. So that would be a sales budget. Simple, isn't it? So your price times quantity. Now, in real world, even for Apple, which produces only a handful of products, Apple is one of the greatest companies that has ever existed in this world. I would say one of the greatest in the sense that the radical, the revolutionary nature of its products, and being, I think, one of the largest companies in the world, or sometimes it is the largest in terms of market capitalization. They have a very small number of products, very small range, very thin, slim range of products. So instead of thinking of just one model, let's say we have 3 models. Like for iPhone 11, they had iPhone Pro, I think, then iPhone Pro Max, and iPhone something else. So for iPhone 12, in all probabilities, there are going to be 3 different models. So say model iPhone 12 Pro or 12 Pro Max, or iPhone 12 say standard. So product model number 1, 2, and 3. Say we're going to sell each one for $1,000. The slimmest model or the simplest one, say $750. That's next one, say $850, and the third best one, $950. Although I think the Pro Max is going to be $1,250, so it's going to be, it could be $950, $1,150, and $1,250, or $750 and $950, $1,250, and forget about that. So if you have 3 products, you're going to have 1 million each. So 1 million times 750, so that's $750 million. Then 1 million of the middle one, intermediate one, and again, it's going to be that 1 million is going to be sold at $950. So that's $950 million. And then the top of the range one is going to be sold at, say, $1,250. So let's assume for simplicity that we're going to sell that one we're going to sell 1 million units of that one too. So that's $1.25 billion for the top of the range, model. So the total is going to be, just add the 3 numbers, 750 plus 950 plus 1250. So it's going to be $2,950 million, or $2.95 billion. So about $3 billion worth of sales if you have 3 products. All right, now, after you have decided to sell 3 million units of iPhone 12s, you now need to manufacture. You need to have a budget to manufacture. So those units must all be manufactured. All right, so how do we decide how many units would like to produce? So that's called the production budget. So that's our second budget, which is the production budget. So production is, the formula is simple. The number of units that you'd like to, or you'd need to produce, depends on number one, how many units you'd like to sell. So enter that into your equation. The desired sales, or desired quantity, desired sales quantity, or quantity to be sold, plus how many units you'd like to have in stock at the end of the year, because you're not going to have iPhone 12 by the end of 2021. So it usually take about 2 years to roll out a new line of iPhones, or the next generation iPhones. So I would assume that if you'd like to sell 3 million units of iPhones, then at the end of the year, you'd like to have at least say 10% of it. Say 10% of 3 million is 300,000. So 300,000 units would like to see in our stores as ending finished goods. In other words, if I sell 1,000 or sell 100 units during the year, I'd like to see 10 units in my ending or closing inventory of finished goods. So desired sales plus desired ending. Remember, desired sales plus desired ending. So that's 100 plus 10, so 110, minus beginning. So at the beginning, how many units we have? Well, we don't, probably at the beginning of 2021, would have some, because iPhone 12 has already been launched at the end of 2020. So let's say beginning inventory is 200 units. So how many units you need to manufacture during the year? would like to sell 100, remember, our sales target is 100 plus 10 is 110 minus say 20 units. Or if it was 1,000, our sales target is 1,000 plus 100 to be there at the end of the year is finished goods. So 1,100 minus, we have 200 units at the beginning of the year. So 1,100 minus 200 is going to be 900. So 900 units is what you need to produce. So you now see how your production budget works. So this is the formula: desired sales plus desired ending inventory. I have 1,000. I assumed 1,000 units is desired sales plus desired ending is 300. So 1,000 plus 300 makes it 1,300 minus 200 is what you have at the beginning of the year. So I need to produce 1,100 units here. All right. So desired sales plus desired ending minus beginning is what you need to produce. Excuse me. Now, this is for a manufacturing company. You need to use this to find out your production. Sorry, use this formula to find out your production budget. Once production budget is initially just some numbers, units. Production budget is not going to be in dollar terms yet, because we don't know the cost of production. We haven't done a budget for labor or overhead or material. We just know how many units we would need to produce. So this is an important thing that many people, many even accountants, many students forget. Remember, your sales budget is in dollars. Sales budget can be in dollars as well as in units. But production budget is going to be only in units. Production budget is not going to be in dollars. You don't need to know the dollar amounts yet, because right now you need only to know how many units they need to produce. And then you go out and start looking to procure your materials, labor, and overhead. Like, if the chef knows that I'd have to make 20 dinners or 20 breakfasts, then they go out and do groceries. All right, so this is a number. This is a unit. This is only units. Production budget is going to be expressed in units. Excuse me. I go back here. The purchase budget, although I call it materials purchase budget, but I'd say, hang in there. You can see in the previous slide, we said the purchase budget. So although I said materials purchase, but it's actually purchase budget. So now, if you're a merchandiser, like Macy's or Best Buy or Fry's, then you don't manufacture the things that you sell, but you still have to buy. So what do? You find out your purchase units, the ones that you need to buy. Not ignore the word materials, just call it a purchase budget. So our purchase budget is going to be, this is for a merchandising company, because they purchase and sell. They don't manufacture. So their purchase number would be their desired sales in units plus desired ending inventory in units minus beginning. Same formula, but they'll not call it units to be purchased. They'll say units to be, they're not going to call it units to be produced. It's not their production units. It's going to be their purchase units. You got it? Back. A sales budget supported by a purchase budget, not a production one, because it's not a manufacturing company. It's a merchandising company. They buy the same commodities that they sell. All right, so purchase units plus desired ending minus beginning is what you need to purchase. So that would be, you can see, that would be a purchase. Now I said that this formulation is derived from the cost of goods sold formula. See, we all know the cost of goods sold formula is beginning inventory plus purchases minus ending inventory. That's our cost of goods sold, isn't it? Beginning inventory plus purchases minus ending gives you cost of goods sold. So cost of goods sold is what, in terms of units, is going to be sales. Cost of goods sold means the cost of items sold. So here we know the number of units sold. So now let's put it in a different order. Here, this is our last line. Cost of goods sold is our outcome, is the bottom line. But let's take it back to the top. So cost of goods sold, or the number of units that I need to buy, is equal to, if you go back, is beginning, we don't need beginning inventory, is actually the units sold or sales units plus the desired ending. So this bottom two, you can see these two are always equal to these two. This is the bottom two, the cost of goods sold and ending. These two together is always going to be equal to purchase and beginning inventory. I wasn't sure if you saw it. So your sales, the bottom line, the last line, and the penultimate line, the line before that, second last. So these two together, these two, the sum of these two is equal to the sum of these two. So see, your sales is 800. Sales is 800 plus desired ending was 300. So that's 1100, isn't it? That's 1100, and that's also exactly equal to your beginning inventory and purchases. These two together is also 1100, isn't it? These two together, they add up to 1100, and those two together add up to 1100. So if we reverse it in order, we're going to see my purchase, or this 1000. This 1000 is going to be equal to my sales 800 plus desired ending. So that's 1100 minus my beginning. See, these two together is 1100. So from the 1100, if I subtract either of these, I'm going to get this other one. So 1100 minus 100 will give you 1000 units that you need to purchase. So this production budget or purchase budget formula is actually derived from the cost of goods sold formula. But it makes common sense, because I need to know how many, like how many people I have invited. So if I've invited 50 people, I need 50 boxes of lunch. Plus, for contingencies, if I'd like to have 3 spares for my colleagues or for my people who serve that lunch. So 50 plus 3, I need to arrange for 53. And if I have 0, the beginning of it, you'd like not to have any, because you'd like to have all fresh. But if you do have any beginning inventory for food, you don't like to have cooked food as beginning inventory. But for say biscuits, or for automobiles, for phones, for anything that's not perishable, it is possible to have, and it's quite natural to have some beginning inventory. All right. So desired sales plus desired ending minus beginning is your purchase target or production target. All right. So we have the first two covered. Now, once we know how many units we need to produce, so here we had 1100, we now need to manufacture those. So to manufacture, we need to purchase materials. All right. So let's assume that for 1100 units, we need to have 3 pounds of materials each. For each of 1100 units, we need to have 3 pounds of materials. So how much material we need? What's the production requirement? Don't say how much material we need to purchase. Just stop there. That how much materials we need to support this production. So we're producing 1100 units, and if each unit takes 3 pounds, we need 3300 pounds. So that's our production requirement. That's not necessarily the purchase requirement. Got it? That is not necessarily your purchase requirement, but that's a production requirement. To produce 1100 units, I'd need 3300 pounds of materials. All right, so that's my production requirement. Plus, how many units I need or I'd like to have at the end of the period, because you don't want to have a stock out. Stock out is costly. Stock out means not having any stock or running out of stock. So that leads to a haltage in production, or we call it layoff, or so you need to lay off your machines or lay off people because you are out of stock. All right, so we don't want that happen. So 3300 units, 3300 pounds is what we needed to support the production, plus desired ending. So desired ending is we are assuming 500 units, 500 pounds here. So 3300 plus 500 pounds is 3800 pounds, minus beginning is 200. So I have 200 pounds in my beginning inventory of raw materials. So 33 plus 5 is 38, minus 2 gives you 3600. So this 3600 pounds is what I need to purchase. So that's my materials purchase budget. You want to see again how we worked it out? My production requirement. See, materials requirement to support the production. Our production was again 1100 units. 1100 times 3 pounds is 3300. So that's my materials requirement plus desired ending. Desired ending is also always going to be added to what's your original requirement or periodic requirement is. Because we don't want to run out of cash, for example. Say, you know, I'm going to drive, say, 200 miles tomorrow. So to drive 200 miles, if I need 5 gallons or 6 gallons of gas, I don't want to buy only 6 gallons. But I'd like to have some gas at the end of the trip. So my trip itself requires, say, 7 gallons, plus I'd like to have another 7 gallons in there. So I'd need to purchase 14 gallons. That's how it works. So desired ending is also always added to your current requirement. All right, so materials requirement plus desired ending. So there's 38 minus beginning is 200 is 36. So 3,600 pounds is what we need to purchase. We need to procure that. So now 3,300 pounds multiply. I haven't gone into details in prices. So if each pound is, say, $5, if each pound costs you $5, then 3,600 pounds multiplied by $5 is what is your materials purchase budget. All right, so let's say materials are already purchased. Now here we assumed one material, but in real world, how many materials you think you'd need? How many types? How many parts go into an aircraft? How many parts go into an automobile, a vehicle, or even a phone? So there could be hundreds or thousands in an aircraft. So but the process is the same. Instead of having one column, you'd have probably multiple columns. So if you need 3 types of materials, like for these t-shirts, for example, you need buttons, you need other accessories, you need the fabric. So if you need to purchase those 3, 4, 5 different types of materials, then there would be same rule. So you just have different columns for material number A, B, C, D, E, or number 1, 2, 101, 102, 103. For each row or each material, you'd apply the same principle, same formula. You'd say, this is my production requirement. So for, say, 3,300 t-shirts, if I need, say, 3,300 meters of fabric and, say, times 4 buttons, so 3,300 times 4, there's that many buttons is my production requirement. Plus, I don't want to run out of buttons at the end of the period. So plus desired ending. Minus, I might have some buttons in my stock now. Minus beginning. So same like gas example. My traveling costs 7 gallons. I'd like to have another 8 gallons in stock. So that's 7 plus 8, 15 gallons is what's my desire. But I might already have 5 gallons there. So I'm going to pump in only 10 gallons. Well, that would check all my boxes. That would let me burn 7 gallons of gas to get to my destination, and I'll still have 8 gallons in stock in the tank. All right. Now the labor budget, one of the simplest ones. Labor budget is simpler because it doesn't have any beginning or ending inventories, because you can't have any beginning inventory of labor. Labor is real time. You see, labor is real time. So that's wonderful, like energy, electricity. You cannot have beginning and ending inventories. All right, so labor budget is, remember the 1,100 units that we would need to produce. So let's say to manufacture 1,100 units, we need half an hour for each one. So 550 hours times $16. So that's direct. So labor budget is equal to production budget. So that's 1,100 times direct labor hours per unit multiplied by hourly rate. So 1,100 times 0.5 times hourly rate of $16 here. Can you see? 1,100 units times half an hour for each unit times $16. So that's our labor budget. Simple, isn't it? Now let's move to manufacturing overhead budget. Manufacturing overhead is easy. It is not the easiest, but it's still easy. It will have a variable component and a fixed component. So fixed component doesn't depend on how many units you manufacture. Fixed component is going to be known, like your rent. So whether I do 3 hours of work or 5 hours of work, I would need to still pay the rent. Like next month, there are not a lot of classes. We're going to have Christmas, we're going to have December. So the next semester doesn't start until the beginning of January. So there are not much teaching activity, but the rent is still going to be there. The energy is still going to be there. The internet, the Wi-Fi cost is still going to be there. So these are called fixed overhead. Okay, fixed manufacturing, that is. We're not yet to selling and distribution and administrative and general expenses. Also, manufacturing overhead is easy, as I said, because manufacturing overhead is going to be equal to your variable manufacturing overhead plus fixed manufacturing overhead. Variable plus fixed. So variable one would depend on hours. It could depend on units as well. It could depend on machine hour, labor hour, or even number of units. So that formula would be given. You'd be told, you'd be given that information. So the variable, let's say in this case, the variable rate is say $2 per labor hour. So we know that we need 550 hours of labor working here. No beginning or ending inventories. We need labor only to do the production, to carry out the production of 1100 units. So each one needs half an hour. So 1100 units would need 550 hours. So that 550 hours is when we would need all variable manufacturing overhead to shed, to shower their blessings. If I have labor working here for 550 hours, all 550 hours I need the heating to go on, the air conditioning to go on, the lights to be working, the kitchen appliances to be in good order, and the furniture to be not broken, water to be there, all the utilities. So these are all fixed overhead. And then variable overhead is 550 hours times say $2 of variable overhead. So that rate would be is something that we remember in chapter 3 we did manufacturing overhead in job costing and also in process costing. So let's assume that hourly rate is known, that when a labor works, for every hour we spend $2 in variable overhead plus the fixed overhead like fixed rent and internet and taxes, property tax, for example. All right, so that's the manufacturing overhead budget, variable overhead, variable manufacturing overhead plus fixed manufacturing overhead. So I assumed $5. So 550 hours, you can see, times $5. So that's a variable manufacturing overhead plus I assumed $5,000 to be fixed overhead. So the two together is going to be our total manufacturing overhead budget. All right. Now we have the two operating expenses, the selling and distribution and the administrative and general. So selling and distribution, again, it could have, it normally doesn't, but it could have some variable overheads. So if it does have variable overhead, that would be like commission. So it would depend on sales, units sold, not on production. So if we sell 1,000 units, and if we spend like $2 of variable overhead on that, then that's $2,000. Plus fixed overhead is like fixed advertising, fixed vehicle depreciation, fixed space cost, fixed insurance, and other things of the sales force. So variable selling overhead or variable selling cost plus the fixed selling cost. Likewise, administrative, we have variable administrative overhead, which is very uncommon, but there could still be variable overhead and fixed overhead. So administrative expenses are usually fixed. So chances are that you would not have much of a variable rate. Well, now once we have that, we are now in a position to prepare our income statement and balance sheet, the budget, the pro forma income statement and balance sheet. So those are called budgeted income statement and budgeted balance sheet. All right. The final one is our cash budget. So cash budget has cash receipts and disbursements. Cash receipts and disbursements. So cash receipts depend on these factors. What are they? Sales, how many units you're going to sell and at what price. So sales dollars. Your credit policy, how are you going to sell it? How lenient or how conservative credit policy you have. So some stores have said, they say, well, no credit, it's all cash sales. But as I mentioned in a previous video, that you cannot have any large company. You can imagine of a large company who doesn't extend credit. So we'll have a credit policy, but we need to know before we do the budget. I'm not in favor of a more conservative or liberal credit policy, but I need to have the policy. So whatever policy you think right for the company, have your policy. That's not the budget guy's duty to design your credit policy. I'd assume that some other people who have direct knowledge about the market, direct knowledge of competitors, of competition, competitors and direct knowledge of the economic conditions of the consumers, they will decide the credit policy, all right, or of your, not just consumers, of your wholesalers or whoever is your user, or consumer, purchase buyer. So understanding the buyers, understanding the demand, understanding consumers, understanding market competitors, prices, people's income, interest rates, and all those, and even weather. Understanding all those things, geopolitical issues as well, any political unrest, strikes, or any change in government, or war, or other things, pandemics. So you'd have to, if you are in a pandemic, or if you can predict, I don't think you can predict pandemics, but once you are in one, then you can predict if it continues like it has been continuing this year, that it's your next year budget. In doing your 2021 budget, you'd need to take the pandemic into account as well. And your sales, then your credit policy, then your collection policy or collection effectiveness, collection efforts, and your allowance for bad and doubtful debts. That's very important. Your allowance for bad and doubtful debts, that also determines your cash receipts, and then cash disbursements would depend on this list of factors. Would you have here your purchase requirement? Because you disburse cash, you spend cash to purchase materials, labor, overhead. Then your payment terms. So you're purchasing, say, $1,000 or $5,000 worth of materials, but you were able to negotiate a very lenient, very liberal credit policy. So you don't pay until, say, until the next year or next month. So your payment policy or payment terms is important, is one of the factors that drive your cash disbursements. And then your labor rate, your overhead cost, your cash versus accrual expenses, like having a lot of depreciation doesn't affect your cash budget. So your cash versus accruals and your capital expenditure plan, your loan repayment terms, any loan repayment plans you have, or any loan early repayment, or if you don't have an early repayment plan, you'd have a repayment plan, because if you have loans, of course there will be calls for payments. So how those payments are going to be made, and what frequency and what amounts. But companies sometimes have a plan to retire to pay even more than what's the minimum requirements. So I need to have information on those, your loan repayment plans, and finally I need to know your dividend policy. Also, take a look at the factors again. Long list of factors on which cash disbursement depends, and the smaller list of factors on which cash receipts depend. Got it? That is cash receipt and cash disbursements. All right, so that's our first part of the discussions. Now we're going to do some practical exercises and solutions. We're going to solve some of the problems from our Connect assignment. So I'm going to do a screen share now. Welcome to screen share. This is what I'm going to show you. All right. So here we are. We're going to share the screen. So this is problem number 1. We have 10 questions here. And the first one is my glasses. Hi. All right. So this is WLR Company. The budgeted sales for the upcoming fiscal year are provided below. I hope you can see this. I hope you can see the screen. So you can see the budgeted unit sales in the 4 quarters are 23,000, 24, 21, and 21,000 respectively. So these are their units, sales targets in units, budgeted unit sales. So what are you going to do to have this, to have a complete budget? Simply multiply these 4 numbers by unit selling price or expected unit selling prices. So it says the company's variable selling and administrative expense per unit is $2.20. That's variable selling and admin. And fixed selling and admin include advertising and other expenses of $8,000 per quarter. Executives, so advertising is $8,000. Executive salaries of $41,000. Depreciation of $22,000. In addition, $1,000. In addition, the company will make insurance payments of $5,000 in the first quarter and $5,000 in the third. Finally, property tax of $7,400 will be paid in the second. So there will be different payments or different types of payments at different time periods or different points in time. Prepare the company's selling and administrative expense budget for the upcoming fiscal year. So this is not one of the best examples, but that's how it popped up as number one, because I would have preferred to have a sales budget, then a production budget, and then materials purchase budget, labor budget, and all those. But this is also fun to just have a small component. So they wanted you to have a selling and distribution, selling and administrative expense of the operating expense budget. Essentially the operating expense budget. All right. But I'd like to extend it to the sales budget as well. So what I'm going to do, let me show you something. So let's say we do a sales budget here, a quick sales budget. So I will have first quarter, the second, third, and fourth. So have your 4 quarters here. And then the total or annual. So see what I'm setting up. 4 columns for 4 quarters and a 5th one for the total. Got it? Now sales. So we're going to have a sales budget, quick sales budget. You can see live. So our first quarter sales target is 23. So we have sales in units. I put quantity 23, then 24, 21, 21. So 24,000. The third quarter is 21,000. And fourth is also 21,000. So the 4 quarters together is going to be 23, 24, 21, and 21. So just add the 4 and it would be 89,000 units. So total is going to be 89,000 in the total column. So those are our sales units. Budgeted unit sales. Now multiplied by the selling price. So the selling prices or selling price isn't given here because they wanted only a selling and distribution, selling and administrative expense budget. But there are variable components of those budgets. That's why they gave you the units of sales units. Anyway, so let's say the selling price is SP. So just multiply each one of those by SP, which could be $4, $40, whatever. SP on SP. So simply multiply each of these numbers by your selling price, which could be $2 to, could be 2 cents or $2 million. If it's aircraft, although I don't think you can sell 23,000 aircrafts, but it could be vehicles, that are quite expensive, or it could be just burgers, which could be as low as $1 each. All right, so I'm using SP, selling price. But how we do the selling and distribution and the admin expense budget, simple. You see, I'm going to show you the working, but if I was to do it here in front of you on camera, then this is how I do. I'll keep the quarters as they are. Then our first is variable selling and admin. So I'd say I already have the units. So sales units. So 23,000, 24, 21, and 21, and finally 89. So these are my sales units again, multiplied by variable selling and admin expense. So times variable selling and admin. How much? $2.20. So multiply each one by 2.2. $2.2. $2.2. So you have the variable selling and administrative expense budget. So that depends on, they said the selling and administrative expense budget, or the $2.20 depends on $2.20 per unit, not per hours or anything. As I said, that our manufacturing overhead uses machine hour, labor hour, or number of units as the drivers, as the allocation base. But then when you get to selling and distribution or admin expense, that's usually based on sales, not on production or hours or labor or machine. That's on exact sales dollars, either sales dollars or on sales in units. All right. So we have, I'm not going to do the multiplications here on camera just to save time. So, and also I don't want to get it wrong. So we just multiply the expected sales units by $2.20 to get our variable selling and administrative admin expense budget. Then we have the fixed ones. So now have fixed, put a column. The first one is going to be advertising. So advertising, they said, is $8,000 per quarter. So I'm going to put 8,000 in each column. All right. 8,000 in each column. And the final column is going to be 4 8s are 32. So $32,000 of advertising. Then we have executive salaries. Exec salaries, how much? 41,000. So simply have 41,000 in each column, or just 41. So 41 times 4 is 160. I put the total in a different color pen. So $164,000. So that's sum total of all four. So take another look. You're filling in, you're populating your variable, fixed items. First one was advertising, $8,000. You can say 8,000 in each column. And the second one is executive salaries, 41,000 on each column. And then the third item is depreciation. Again, put the same amount, same number on every column. So it's $22,000. So 22, 22, 22, 22, and annual is going to be 88. That's a depreciation budget. Then the company will make insurance payments of $5,000 in the first and the third. So insurance, 5 in the first column and 5 in the third column. Annual is going to be $10,000. And then it will pay $7,400 of property taxes. That is in the third quarter. So in the second quarter, so that's $7,400, and in the annual column, 7,400. So nothing here, nothing here, and nothing here. We have the budget. We have the answer to your assignment. Take a careful look. Well, why don't I stop sharing now for the moment? Okay, guys, see what we've done here. Sorry, I didn't realize that you wouldn't have a full view when I was showing it. So our sales budget, these are the sales numbers, not the sales budget. These are the sales in units. Expected sales, 24, 20, 23, 24, then 21, 21,000 units. That's our selling price SP, So to get the SP, we would get the sales budget. So that would be our sales budget. The first 3 lines. So we haven't done the sales budget, but if we did, that would be our sales budget. Okay, now I'm using the same sales numbers to have my selling and administrative expense budget. Remember, in the selling and administrative expense budget, I don't need the sales revenue. I don't need it, but I just need the information of the units. So they said that it starts with our advertising. Well, initially variable. So the variable was $2.20 each per unit. So we have 22, let's say in a particular quarter, we have 23,000 units to sell. So 23,000 times $2.20 would be our variable selling and administrative expense budget. So same 2.2, same unit rate times the units. So I reiterated the units here again, 23, 24, 21, 21. That's our units. You can see sales and quantity multiplied by variable selling and administrative expense per unit. So that's $2.20. And then these are all the fixed ones, starting with advertising, executive salaries, depreciation, insurance, and property tax. 5 items. Advertising, executive salaries, depreciation, insurance, and property tax. You just have to keep track of when it's due, like insurance was payable in the first and third quarters, and property taxes are payable in the second quarter. So that's the company's plan. All right, so you can see you have a budget here. So the first problem is solved. You can see. Now let's look at their solution. Exactly what I did. See, I did this whole thing right in front of you. You can see budgeted unit sales in the first row, 23, 24, 21, 29. So ours is 89. Theirs is also 89. Times the 2.2. Can you see 2.2 there? Multiplied by 2.2. You see, I multiplied them by 2.2 as well. So these are my 2.2s. That's 2.2. What I didn't do is I didn't write down the products of it. Like what is 23,000 times 2.2? So now know it's $50,600, then 52.8, 46.2, 46.2. So just complete that row. And then the fixed items, advertising 8,000 each, executive salaries 41 each, insurance, property tax, and depreciation. So that gives you the total selling and administrative expense. Just add all these numbers. We have the variable, then you have the fixed. So variable and fixed together is your selling and administrative expense budget. Then we subtracted in their solution, they subtracted depreciation to have the cash flow effect, because you would need those numbers for the cash budget while doing the cash budget. But remember, if you are doing the pro forma income statement, remember the budgeted income statement, then you don't need cash. Then depreciation is okay. Depreciation does go into the income statement. Income statement is not a cash statement. It's an accrual statement. So items that are paid or that are not paid doesn't matter. Whether if the item was, as long as the item was due to be paid, as long as the item was expensed, no matter whether it was paid for or not, as long as the resource was used and money or expense accrued. All right. So to do the income statement, we wouldn't exclude depreciation, but to do the cash budget, we would exclude depreciation. That's why we used a row here to subtract depreciation. And the final, so that gives us cash disbursements for selling and administrative expenses. So there are two notions here: the total, the real selling and administrative expense budget, or the budgeted selling and administrative expense, and then cash requirements, the cash flow effect, cash disbursements for selling and administrative expense. So that's number one. So let's go to window number 2. I still do not know why so many people have not even started the assignment. So please do it. Please watch the video and do it. Well, at number 2, let me put on a black frame now, reading glass. All right. So this one is Silver Company. They make a product that is very popular as a Mother's Day gift. Thus, peak sales occur in May of each year. It's shown in the company sales budget. All right. So budgeted sales, April, May, June. So this is a quarterly budget, just 3 months, 3 columns. From past experience, the company has learned that 30% of a month's sales, so this is going to have a component, a little bit of a flavor of a cash flow, a cash budget. So the company has learned that 30% of a month's sales are collected in the month of sale. Listen carefully. 30% of the month's sales or sales revenue is collected within the month of sale. And another 60% are collected the following month, the month following the sale. So March sales are going to be collected in April, or April ones are going to be collected in May, and so on and so forth. All right. And the remaining 5% are collected in second month following the sale. So no bad and doubtful debts, no bad debt expected. All right, so 30% within the month, 65 the following month, 5% in the second following month. Perfect. Bad debts are negligible and can be ignored. February sales total $250,000 and March sales total $280,000. Now, you tell me why they gave you the February and March sales. The budget is for the second quarter, April, May, and June. Notice this. The budget is for how long? For what period? Second quarter, April, May, and June. But we still need information about February and March. Why? You're going to soon find out. So the requirements are: prepare a schedule of expected cash collections from sales by month and in total for the second quarter. And what is the accounts receivable balance at the end of the quarter, or on June 30th. All right, so let's try to solve it. I'll do only a couple of rows. You can do the rest. All right, so I will have columns for the budgeted periods, which are April, then May, June, and total. So the total second quarter. Remember this: April, May, and June. So have the corresponding columns. The requirements are budgeted cash collections. So I'd still have one row for sales, and then I'll work out the collections. All right. So the sales, and that's why I'm going to create 2 extra rows for February and March. You'll find out why. So I'm using a blue pen here. That's February and March. So let's have the sales information. Sales in February was 250. March was 280. And then these months are 320, 520, 180. The total for the second quarter was $1,020,000. So I'm writing all items, all numbers in thousands of dollars. Thousands, so I'm ignoring the 3 zeros. So that's our sales. But that is not all going to be collected. So below that, I'd like to draw a line. So draw a line to indicate that these are not going to be parts of the calculations, so that they can enter our calculation. But I need the information nevertheless. All right, now come to collection. I don't actually need the information anymore. I have it in my mind. 35% in the month of sales. So have the collections like this. So you set it up like this. Have the 2 extra months here, February and March, because they have legacies. February is going to affect February, March, and April. So April has a connection with February, and May has a connection with March. But we don't need January because January's collection, January sales would have been collected in January, then primarily in February, 35% in January, 60%, I think 30% in January, 65% in February, and 5% in March. Remember the second month following. So that was the policy. Let's go back and check the policy again. We're sharing the screen. So what do we have? It says 30%. So 30, 65, and 5. 30, 65, and 5. All right. So collection. Read this one. That's a collection. Then within the month, so February will have had collections that month. So 30% of 250 is 75. 30% of 280, 84,000. 30% of 320 is 96,000. 30% of 520 is 156,000. 30% of 180 is 54. And 30% of 1,020,000 is $306,000. Remember, what I did, I'm focusing on the money that we will be collecting within the month. So simply sales times 0.3, sales times 0.3, sales times 0.3. Each number, each row, the full row multiplied by 0.3 there. Excuse me. The full row, the sales revenue times the 30%. All right. Then month following the sale, so February collection is going to be in March. March one's in April. So April is going to be affected now. So March one's in April. How much? 65%. Remember 30, 65, and 5. So I need the calculator now. So 30% of respective months have already been collected within the month, then 65% in the following month. So February is going to affect March. So let's complete that. 250,000 times 0.65. So that's 162.5. So that's in March, 162.5. And then keep an eye on March sales and see how it affects your April collection. So 280 times 0.65. That's 182. Now, April is going to affect May. So 320 times 0.65. 320 times 0.65. That's 208. And 520 times 0.65. 336. And 180, the June is going to affect July, but we don't have a column for July. Ignore it. So now the second quarter is going to be the totals of April, May, and June. That's 728. So 728 is going to be collected as part of the month following, but falling into the quarter. So I'm going to have a separation, although I had those two extra columns for February and March, but I think for clarity, we need to separate the actual solution here. So the actual solution is going to be only April down to June. And then the total for the quarter. So please see here, what we have done. That's our real solution, the April, May, and June. But see, February has affected March. So I have taken like 65% of this February sales and put it in March. Then 65% of March sales I put in April. So this would be irrelevant. You know, you can drop it from the solution once the solution is ready. So this is the connection. March is going to affect April. April sales, May sales, June. June sales is going to affect July, but that's beyond our requirement. Okay, so that's our month following the sale. And then second month following the sale. So I have a different color now. So second month. Following the sale. So February, second month is February, March, and April. Now, even February is affecting April. Can you see? So February is 250 times 0.05. That's 12.5. So February is going to be empty because February, we don't have January information. And even March is empty for the second month, but February is going to affect or April. So April is 12.5. See what happened here, what I did. Look at this 12.5. Where did I get it from? 12.5 is 5% of this. This 320. Sorry, 250. There's $250 or $250,000 of sales in February, but 5% of that is going to be collected in April. So February affected February, February affected March, and February affected April. Every month is affecting 3 different months. All right, so that's the effect of February on April. But what about the effect of March on April? Well, we have already done that. But now March has effect on May, the second month. So March sales at 280 times 0.05. So each one is going to be multiplied by 0.05. So that's $14,000. And then April is going to affect June. So 320 times 0.05. That's 16. And June is going to affect, of course, August, but we don't have it there. So add the 3 columns. That gives us 42.5 for the quarter. So these are our cash collections. What are they? Cash collections, so you just add the 3 numbers for each column. Okay. Are there any more requirement except for the cash collections? Let me see. So requirement 1 is prepare a schedule of expected cash collections from sales. So no cash payments. We don't have payment information. We don't have purchase information. So that's our cash collections, expected cash collections for the months and the quarter. All right. I just have this, this, and this. So at the 4. Simply add the 4 columns, the 3 quarterly, 3 monthly columns, and the 4th is for the whole quarter. And there was a second requirement is what is the accounts receivable balance at the end of June. All right, so let's finish it. 96 plus 182 plus 12.5. So I'm not going to do anymore. So 290.5 is our April collection. So likewise, there will be May collection and June. And add the 3 to get the quarterly collection. All right. Now, how do you calculate the accounts receivable balance? So it tests your knowledge of accounting, financial accounting. Accounts receivable is the money that is still outstanding. So it has to be sales, but not collected yet. Sales revenue that's still uncollected, that's still due to be paid. All right, so when you're at the end of June, what sales are still outstanding? So remember what happened to June. From June, only 30% of the sales, 30% of June sales have been collected, will have been collected in June. How much? 30%. So 70% of June sales are still out in the market. All right. So calculate the requirement 2. This is requirement 1 and make it requirement 2. So accounts receivable. So I'm going to have for each month. So June, based on like the June sales, what part of June sales are still outstanding? June sales was 180. What is going to be 180 times 0.7, because only 30% would have been collected in the month of sale. So that would be 126 that's still uncollected. June sales uncollected in June. What about May? May sales will have been 30% of May sales will have been collected in the month of May. 65% will have been collected in the month of June. Only 5% will have been uncollected, still be uncollected. So May 520, May sales is 520 times 0.05. Just 5% is still uncollected, so 26. So May accounts receivable still on June 30. So $26 or $26,000 of May sales are still uncollected at the end of June. What about April? All April sales will have been collected by the end of June. So no April sales are uncollected. April, 30% in April, 65% in May, and 5% in June. So at the end of every month, put it this way, at the end of any point in time, you will have two previous months. One would be current month and another would be the month before. Because by the end of the third month, everything is collected. All right, so that is the total. So 126 plus 26 is 152. That is your answer for the accounts receivable balance. See, accounts receivable balance on June 30th. This is 70% of June sales. This is 5% of May sales. How much is May sales? May sales is 520. So 5% of 520 is 26. And 70% of 180 is 126. 70% of 180, take a gain. All right, so now let's see if we got it right. Screen share again. Let's see, requirement 1 is 1076.5. I have 290.5 plus. I didn't want to do those. So let's assume, let me see. 12.5, 182, 96. 12.5, 182, 96. Then 14, 28, 156. Yes. The 16, 36. 16, 330. Then 338 and 336. So 54, 338. That's collected. Okay, let's check again. Maybe we have a mistake. So May 520 times 0.65. 238. Yeah, I wrongly saw it as 336. So that's 338. All right. So 730 would be the total. 338 plus that's perfect. No change there. All right. So that gives us 306 plus 728 plus 42.5. 1076.5. Wonderful. We got it right. 1076.5. There's the quarterly collection. Quarterly collection here. And the balance, the accounts receivable balance at the end of the quarter is $152,000. We got both of them right. You can see the first one and requirement 2 is 152. Yes, we got them right. All right. So let's look at question number 3 now. These are small, brief questions. Number 3, so we need to speed up a little bit. Number 3 says, the Down Under Products of Australia has budgeted sales of its popular boomerang for the next 4 months as follows. So we have the unit sales for the 4 months. You can see here, 78, 85, 118, and $94,000. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that end of month inventory levels must equal 20% of the following month's sales. So that's desired ending. At the end of every month, you would like 20% of the following month's sales in units to be lying in your finished goods inventory. All right. The inventory at the end of March was 15,600 units. They helped you with March ending inventory because March ending inventory is April's beginning inventory. But see, these guys, people like Garrison and Horngren, they are very student friendly. I tell my students that Americans are lucky, or we in America, or in other parts of the world, sometimes in Australia, Canada, UK is not as, but in many countries, students are lucky. Why I say that? Because the books are so user friendly. If it was in our country, or if I was writing this book, I'd be mean. I'd be meaner at least. Why? I wouldn't tell you the end of March ending inventory. Actually, I don't need to. This information is superfluous. Why? Because I have April sales, don't I? If I have April sales, so when I'm at the end of March, I had my eyes on April. And the policy says that I would need to have 20% of my following month's sales in units in my ending inventory. So what's my following months? What is the following month at the end of March? At the end of March, the following month is April. And what is the unit sales? The unit sales is 78,000. 78,000. So make 20% of 78,000, and that is 15,600 exactly. That's what they told you. So if you understand the dynamics, the policy of the organization, then a lot of information must be available from the policies. So I wouldn't need anyone to tell me in exact units how many units of ending inventory they had at the end of March, because they gave me April sales. But how many units they had at the end of February, that's what I don't know, because I don't know my March sales. See, if you told me March sales, I'd figure out my ending inventory at the end of February. You see, like tomorrow. So if I know that tomorrow 15 people are going to come here for lunch or for breakfast, then I know how many, what preparations I must have tonight to offer breakfast to 15 people. All right. So now we have that, and the requirement is prepare a production budget by month and the quarter. So must be very easy, isn't it? How do you do the production budget? I'm going to show you, but I want to spend time on more difficult ones. So we said production budget is remember the formula? Production budget is what? Production budget is your desired sales in units plus desired ending minus beginning. Okay? So desired sales April. So again, let's try. April, May, June, and the quarter. So desired sales is the first row. What's the first row? Desired sales in units. So complete that row. Add desired ending. So keep an eye on the next month's sales and take 20% of it. So let me complete the sales information, which is 78, 85, 118, and 94. $78,000, 85,000, 118,000 units. And I'm leaving the quarter. Well, I thought I'd leave it empty, but we can complete it. So that's 281 for the quarter. See, in the question, they gave you July sales, but I'm not having a column for July. See, these are some of the things that only practice can teach you. See, May, June, July, sorry, April, May, June, second quarter, and then the quarter. So I don't have a column for July, but what's the use of the July sales information? July sales information is going to be used to estimate ending inventory at the end of June. We would need June ending to have the production budget. We need beginning as well as ending. So how would I know my ending inventory estimate at the end of June if I don't know the July sales estimate? So that's why July sales are given, but you don't need a column for July. So desired ending at the end of April would be May's 20%. So now I'm going to look at May. May was 85. So see, your May information, May is 85. So 20% of that is going to be here. 85 times 0.2, that gives you 17. So that's desired ending at the end of April. Then at the end of May is going to be 20% of 118. That's 23.6. And at the end of June, see, now I'm stuck. So I need July information. July sales was 94 times 0.2, that's 18,800. Now, what's the end of the quarter? What's the ending inventory at the end of the quarter? For every, so far, in two other problems, and even here, the quarterly information was the total of these three monthly numbers, wasn't it? The monthly numbers are added to get the quarter number. But ending inventory at the end of June is the end of the quarter as well. So you don't need, not just don't need, you cannot add end of April, end of May, and end of June to get the end of the quarter inventory. Like this month had 30 days. Last month, November had 30 days. So at the end of every day, I had some cash balance. So what's my monthly, what's my month end cash balance? What is my end of the month cash balance? My end of the month cash balance is my end of last day's cash balance. So end of today, or sorry, end of 30th of November is also the end of the month. I don't need to add the end of days balance of 30 days, or end of day balance of 30 days. Okay, so end of the quarter is end of June. So 1 month. So the 18,800 is going to be my end of the quarter information as well. So when you design it in Excel, make sure that you don't sum it up. So that's our production, half of the production budget. So I wanted to show you your desired sales plus desired ending. So we're going to add that. So I'm not going to spin a row here to add the two. I'm going to do the whole thing at once. So now we have minus beginning. beginning quantity. So beginning of April. What was beginning of April? Beginning of April was end of March. So how much was end of March? They told you end of March was 15,006. I said they didn't have to tell you because I have April information. So my April information, April sales is 78,000 times 0.2, that's 15,006. Because at the end of April, sorry, at the end of March, they had to keep 20% of April's estimated sales. So I have April's estimated sales. I'm going to just multiply it by 20% and put it as the beginning of April information, beginning of April units. So that's 15,006. And now after that, you don't need to calculate because you have those ending ones. The ending of the following month, sorry, ending of this month is the beginning of the following month. So ending of April is beginning of May. So I'm going to use, just see what I'm doing here. See, April's ending is going to be plugged in here. End of April is beginning of May. End of May is beginning of June. And end of June is going to be beginning of July. So now this number is going to be this one. How much? 17,000. So 17,000 is going to be the beginning of May inventory. All right. And then 23.6 is going to be beginning of June inventory. So what was beginning of the quarter? So beginning of the quarter was beginning of April. So don't add the 3 again. So beginning of April is the beginning of the quarter. See carefully. See, beginning of April, the same. How much? 15,006. That's also the beginning of the quarter. And end of June is also end of the quarter. This one directly goes here. This one directly goes here. So that would now be your production budget. All right. So I'm not going to spend any more time on this. I just take the results to the answers. You can see here 78 plus 17 minus 15,006, 85 plus 23.6 minus 17, and then 118 plus 18.8 minus 30. Yeah, so they have that extra row to have the total needs. I don't think we need, because we know how to add and subtract. So desired sales plus desired ending minus beginning. That gives you the production budget or required production. I call it production requirement. All right, so that's number 3. Let's look at number 4. It's easy, but there's of course there's an intimidation element here. These are reasonably extensive problems. All right, Gig Harbor. The requirement here, the company's budgeted income statement. So it's something new. Let's look at it. Gig Harbor Boating is the wholesale distributor of a small recreational catamaran sailboat. Management has prepared the following summary data to use in its annual budgeting process. We have budgeted unit sales, then selling price, cost per unit, variable selling and administrative expense, fixed selling and administrative expense, interest expense for the period. So you need to prepare the budgeted income statement. What do you need? Unit sales. So sales, you have the budgeted sales times the selling price. It's easy. Minus the cost of goods sold. So you have the cost per unit, 1460, multiplied by unit sales. And then the selling and administrative expense, variable and fixed, and the interest expense. So look at it. Sales, cost of goods sold. So that cost of goods sold, 730, is simply 1460. Let me show you. Cost per unit is 1460 times units expected to be sold, 730,000. So that's our cost of goods sold. And then gross margin minus selling and administrative expense gives an operating income minus interest expense gives you net income. How can you not do this? Okay, so let's go to number 5. Requirement here is direct materials budget, means direct materials purchase budget. So something new. I'd like to do this, or I'd like to discuss it. So it says 2 grams of musk oil are required for each bottle of Mink KRS, a very popular perfume made by a small company in Western Siberia. I was expecting France. Anyway, Siberia, the cost of the musk oil is $1.60 per gram. Remember how much we need? We need 2 grams. 1 gram is $1.60. Okay, budgeted production of Mink KRS is given below by quarters for year 2 and for the first quarter of year 3. There's a reason why they gave you that extra information. The inventory of musk oil at the end of quarter must be equal to 20% of following quarters production needs. So see, finished goods inventory is usually a percentage of the sales next quarters or next year's, next period's sales. Production, raw materials, the ending inventory requirement or ending inventory desire for raw materials is usually based on the production needs. Because you need raw materials not to sell, you need raw materials to produce. All right, so that's 20% of the following quarters production needs. Some 30,400 grams of musk oil will be on hand to start the first quarter of the second year. So beginning inventory is also given. Wasn't necessary. Beginning inventory was not or is not necessary if we have the current of the first quarter's production needs. For example, here the first quarter production needs, you can see total units of raw materials needed. The first quarter is 194,400. So 194,400 times 0.2 is 36,880, and that's exactly the number that they gave you. 30. No, yeah. Well, I mean, if it's different, if they had a different volume, different number of units, then they better tell you. But so that means at the beginning of the period, this company didn't follow their policy. They breached the policy. The inventory of musk should be 20% of following quarters production needs. But 30,400 was there at the beginning of the first quarter. So beginning of the first quarter must be the end of last quarter, isn't it? Beginning of first quarter was the end of last quarter. And at the end of last quarter, it should have been 20% of this, the first quarter production needs. Raw materials needed per unit of finished goods, units of raw materials needed to meet production 152. Let me see, 152 times 0.2, 30,400, yeah. So that makes sense. Yes, so the production need was actually a different amount, was 152,000 units. I looked at a different number, total units. I looked at purchase, raw materials, purchase requirement. Raw material production requirement is different from raw materials purchase requirement. So you need 20% of raw materials production requirement. So they followed the policy. So 30,400 was a spurious information for me. All right, so how do I do it in real time, in real speed or good speed? So what do? You have quarters. So this is question number 4. So you have 4 quarters. First quarter, then you have the second quarter, you have the third quarter, fourth quarter, you have the year, annual. All right. First would be required production in units. Well, finished goods or finished goods, like how many? Well, the first line is the production budget, simply production budget, required production or production budget. Because this problem is about raw materials purchase budget, raw materials requirement, and then multiplied by the prices. So I'll start with the production budget. So I needed to produce 76. So I'm going to ignore the 1,076, 106, 166, 116, and for the quarter, 464. So that's my production budget. How many grams I need to produce each one? So times 2 grams. Units of RM, units of raw materials needed. So that's 2, 2, 2, 2, and 2. So if you multiply that production budget by 2 grams, you need the number of grams of that particular mask that you need. All right, so we have it, mask oil. So if like multiply 76 by 2 makes it 152. Multiply 106 by 2 makes it 212. I'm not going to do the rest. All right, then you have, so this is what is your production requirement. Required number of units, not number of grams, required to produce what you wanted to produce. Now, this plus desired ending, add desired ending. And let me show you how you calculate desired ending. So this is a desired ending at any quarter is equal to 20% of next quarter's production requirement. So we have like at the end of the first, my eyes are going to be on the second. So production requirement there is 212. So times 0.2 gives you 42.4, and that's exactly what they have. So 42.4 is what's my desired ending at the end of the first quarter. And then what's at the end of second quarter? That would be, my eyes would be now on the third quarter. So 166 times 2, 166 times 2 is 332 is at the end of the second quarter, eyes are on the third. So third is 332 times 0.2, 66.4. That is exactly that. And then at the end of the third quarter, eyes are on the fourth, which is 232. So 232 times 0.2 is 46.4. And then the fourth quarter, eyes are on the fifth. That's why they gave you the fifth quarter information. They said the first quarter of next year, we're going to do how many? 86,000 units. So 86,000 units, 86,000 would require 2 grams each. So that's 172,000 grams or 172. So times that by 0.2 gives you 34.4. That's the desired ending at the end of the fourth. That is 34.4. So I put a star here, and that star means 34.4 is the first quarter next year is 86,000 times 2 grams times 20% is 34.4. All right, so that's my production requirement plus desired ending. See, this production requirement, like this is my production budget, times 2 is my production requirement, plus desired ending. They have a row for that. I'm not interested in adding these two. I'll straight away say minus beginning. Now, ending of any quarter is beginning of next quarter. So I can easily put this 42.4 as, say, what I said is that this 42.4 is going to be easily the beginning here. So this is going to go there, this is going to go there, this is going to go there. I just need the beginning here, which I'm going to find out soon. So leave the first column empty because we don't know the beginning of the first quarter. First quarter beginning would be the ending of last quarter. Well, we have a way to know, but for now, the 42.4, the desired ending of the first quarter is going to be the beginning of the following quarter. So following quarter beginning would be 42.4, and then 66.4 and 46.4. Now, what was the beginning? balance of this quarter. That's what they gave us, but I don't need that. I'm going to look at 152 here. See, our production requirement is already known. Our production requirement is already known here. So just multiply it by 0.2. Say again, our production requirement is already known, 152. I'm going to multiply it by 0.2 to get 30,400. That's, sorry, 30,400. So that's what I'm going to put in color. 30,000. 30.4 is there for a reason. Right now, fill in the annual information. So end of the year is also the end of the fourth quarter. So desired ending of the fourth quarter, 34.4 is going to be the desired ending of the year. And then the beginning of the first quarter is also the beginning of the year. So these are our materials purchase requirements. This is going to be the purchase requirements. And once you have the purchase requirement numbers, we simply multiply it by the price. The price was, I think, 1.2 per gram. What's the price? $1.6 per gram. So let's say I'm doing it for just one quarter. So the first quarter being 152, production requirement plus desired ending is 42.4. 152 plus 42.4 minus, that's 164. So call it, it's not the production requirement. What you now have is materials purchase budget. So materials needed to be purchased, that's 164,000 grams in the first quarter, and simply multiplied by, so times the price per gram is $1.60. So if you multiply it by 1.6, you get 262.4. That's the first quarter. For the annual, let's do the yearly. So 928 plus desired ending of 34.4 minus beginning is 30.4. So that's 932. 932 grams, 932,000 grams times $1.60 gives you 1491.2. That's our materials purchase budget. Let's see if we got it right. 1.1491.2. Yes, we got it exactly right. This is your materials purchase budget. See, your production budget times the 2 grams of material you need to produce that, plus desired ending minus beginning is what you need to purchase, times the purchase price. Okay. That's our materials purchase budget. So what do you think? You can probably do it, can't you? You can. Yes. All right. So let's now look at the next problem. Number 6. Following data relate to the operations of Shiloh Company, a wholesale distributor of consumer goods. What do they want? They want a schedule of expected cash collection. So kind of a cash budget. And this is a robust problem and is worth doing. All right, I'm going to do it for you. I'm going to show you that. So things are easy, but we need to understand the company's policy very, very thoroughly, very carefully. So the data is about the current assets. So we have cash. We need beginning cash. We have accounts receivable. Why do you need receivable? We need receivables because part of it is going to be collected during this period. We have inventory, building and equipment, accounts payable. Part of it is going to be paid, common stock and retained earnings. The gross margin is 25% on sales. So once we have the sales data, we know the cost of goods sold data. All right. So the gross margin is 25% of sales. Actual and budgeted sales data are here. The sales information, March is actual. We already have the actual information, $46,000. April, 62, May, 67, June, and July. All right. So we know the partial balance sheet. We know information on their margin, which is 25% of sales, and then the actual sales data and budgeted. Okay. Now sales are 60% cash and 40% credit. So the cash portion, the 60% cash has to be collected within the month. So we're going to have the like monthly columns, and we'll start with sales, and that 60% of the sales data, sales dollars, would be collected within the month, and then 40% would be collected in the months or the month following the sale. So legacy only continues for 1 month. It ends in the following month. Yeah. All right. So 60% within the month, 40% the following month. Well, perfect. So that means we only need one extra month information behind us. There's March information because 60% of March would have been collected in March. Now only 40% will be collected in April. Perfect. So that means they said the accounts receivable at March 31 belong to just March sales. Let's check. We know the March sales. March sales was $46,000 times 0.4 is 18,400, and is our accounts receivable exactly 18,400? Yeah. So that's what I say, that these guys are so user friendly. They didn't need to tell us this accounts receivable. I'd figure it out if, as long as the company complied to the policy. If you're in compliance with the policy, then complied with or complied to. Appropriate use of prepositions. All right, so as long as you're in compliance with the policy, you'll be fine. So the month of March, see, I have their sales data. Their sales was 46,000. So 60% of that sales would have been collected within that month, within March. 40% would be uncollected, and none of February sales are still uncollected. So everything that we have now in the market belongs to March. So March sales is 46, just take 20% of it, and that's 18,400. All right. Each month's ending inventory should be equal to 80% of the following month's budgeted cost of goods sold. See, there's no production here, so cost of goods sold straight away. Your cost of goods sold of the following month, it said ending inventory should be 80% of the following month's budgeted cost of goods sold. We need ending inventory because we need cost of goods sold, which will be purchase, plus desired ending. Sorry, cost of goods sold plus desired ending minus beginning to get our purchases. Once we have the purchases, we'll pay for it, and then we'll pay. And we'll find the price, purchase price, and then we'll have to find the payment policy. Because this is a cash budget problem. So cash budget includes sales budget, production budget. Well, it has effects. I mean, it is affected by everything, even your overheads, as long as it's cash, not depreciation. Okay. All right. So it says one half of a month's inventory. Each month's ending inventory is 80% of the following month's budgeted cost of goods sold. Perfect. We'll do that. Then 1 month of a month's inventory, sorry, 1/2 of a month's inventory purchases is paid in cash within the month. So remember, sales was 60/40. 60% will have been collected within the month and 40% the following month. For purchases, they say half is paid within the month and half the following month. Perfect. The other half is paid in the following month. The accounts payable of March 31 represents March purchase of inventory. That's so sweet. So 46,000 is the March sales. 20% of it is your markup. So 80% would be cost of goods sold. The 36,800 and divided by 2, 18,400. That should be your accounts payable. Accounts payable. Oh, sorry, gross margin is 25, not 20. So March sales is 46,000 times. And then the March accounts payable would be for March, yes. So March sales is 46 times 0.75. Cost of goods sold divided by 2. But that's not accounts payable. Accounts payable looks like 22,000. Accounts payable at the end of March is what? Is that accounts payable says 1/2 of a month's inventory purchases is paid in the month of purchase. The other half is paid in the following month. The accounts payable of March 30 result of March purchase of inventory. So how much inventory purchased in March? Oh yeah. Well, I'm focusing on sales. I'm not focusing on the purchase data. Sorry. I need to do a little bit of the work, like solve part of it. Then I would know how much was purchased. I was looking at the actual cost of goods sold, but that's not purchase. Cost of goods sold is a portion of sales based on the 25% markup. But having cost of goods sold doesn't mean that you purchased that. We needed to know purchases. All right, once you know purchases, then half of it would be your end of period accounts payable. Perfect. Then we are told that monthly expenses are as follows: commissions 12% of sales, rent 1,900, other expenses excluding depreciation is 6% of sales. And assume that these expenses are paid monthly, depreciation is 918 per month. Management equipment costing $1,000 would be purchased in April. So April has to have an extra line for equipment purchases. And I'm not sure whether that be paid. Oh, yeah, purchase for cash. So that was paid for. And then final paragraph or final piece of information is that management would like to maintain a minimum cash balance of at least $4,000 at the end of every month. The company has an agreement with the local bank that allows the company to borrow in increments of $1,000 at the beginning of each month, and then your loan up to a loan balance of $20,000. Interest rate on these loans is 1% per month, and for simplicity, we'll assume the interest is not compounded. The company would, as far as it is able, repay the loan plus accumulated interest at the end of each quarter, at the end of the quarter. So complete the schedule of expected cash collections, merchandise purchase budget, expected cash disbursements, complete the cash budget, prepare an absorption costing income statement, and prepare a balance sheet. Wonderful. All right, so let's not shy away from this problem. And this would be probably our last. I'd let you do the remaining 4. All right, so first is the schedule of expected cash collections. Perfect. So what quarters we have here? Months: April, May, June, July. I have March as well. March, April, May, June, and quarter. I don't have July. Then we have the sales data. But let's have the sales. How to do sales? Sales are 46 in March, 62 in April, 67, 92. And for the quarter, we need to add these three numbers. So it is 62 plus 67 plus 90. So that's 221. The sales, the sales collection, the requirement was schedule of expected cash collections. So of the sales, how much we collect? We collect 40% within the month. So collections, and then first is within the month. So March is collected in March, 23,000, half of 62. It's not 50-50. This was 60% within the month and 40% in the following month. That's what they say. 60% of cash and 40% of credit. Okay. First is we need to find out cash sales and then the collections. I'm sorry. So let's have cash sales first. Sales, and then, so within the month, the next month, and then cash sales. Cash sales are 60%. So of the sales, 60% are for cash. So that means collected within the month. So 46 times 0.6, 27.6. And 62 times 0.6, 37.2. And likewise 67 times 0.6, 40.2. And 92 times 0.6, 55.2. And then 221 times 0.6, 132.6. All right, so we have the cash sales, and then we have the credit sales, and the credits, how much did we collect within the month? 60% is collected in the cash and 40% of credit, and credit sales are collected in the following month. So all the full credit sale is collected the following month. Perfect. So no problem. So our cash sales actually would have been the collection within the month, and then the next month would be 46 times 0.4, 18.4. So that's March sales collected in April, 18.4. April sales collected in May, 24.8. Then May sales collected in June, 26.8. Now, what's collected in March? February sales are collected in March. We don't have February sales. We had March sales, and we used that to find out our April. So I'm going to border April to. I've already used. See, we didn't need to know the accounts receivable, and actually that would match. The accounts receivable is what's been collected in the following month. Okay, so cash sales and then credit sales. Well, just add the two numbers, 2 rows, and there you have the expected cash collections. So let me stop sharing and let me see. Let me show you what I did. These are my unit sales. You can see sales, sorry, dollar sales dollars. Then 60% is collected within the month. You can see cash sales. These cash sales row is 60% of those numbers, and 40% is here. So 40% of them, this is here, this is here, and this is here. Yes, the following month. Now let's see whether I got it right. Requirement 1 is for April 37.2 plus 18.4. It's correct. May 24.8 plus 42. 26.8 plus 55.2. Yes, perfect. So now let's go to requirement 2. Here we have budgeted. The requirement was the purchase budget and expected cash disbursements. So purchase budget is your cost of goods sold. Remember, there's a 25% markup. So that 25%, so your sales was, for example, sales in April was 62,000 times 0.75 is our cost of goods sold. So it is 46.5. So that's what you have here, 46.5. You can see $46,500. Then May would be sales is 67,000, 25% in markup, so times 0.75 is your cost of goods sold, 50,250. So for each month, just multiply the month sales by 0.75. So you get the cost of goods sold, and then plus desired ending inventory. Desired ending would be 20% of the following month's cost of goods sold, not sales. So 20% of the following month. So for example, what's ending in April is May's 20%. So May's cost of goods sold is 50,250 times 0.2. So that's 10,050. And you can see desired ending. Sorry, I can't see that. Desired ending. What's the policy? Each month's ending inventory should be equal to 80%. Sorry, I took 20%. 80% of the following month's cost of goods sold. So May's cost of goods sold is $55,200 times 0.8 should be April's endings, which is 44,160. Cost of May's cost of goods sold is 50,250 times 0.8. 40,200, yes. So I did wrong numbers, different numbers. So May's, what is important here is desired ending. So desired ending at any point in time is the following month's 80% of following month's cost of goods sold. Means 80% of following month's purchases. So May's, for example, May's cost of goods sold is 50,250. See, 50,250 times 0.8 is 40,200. So that's the desired ending in April. So likewise, desired ending May would be June's 80%. June's desired ending would be July. So it would need the next quarter or next month expected sales. So that's why they gave us July expected sales, and July expected sales are $43,000. So $43,000 times 0.75. So that's the cost of goods sold. July cost of goods sold is 32,250 times 0.8. 80% of that is 25,800. Let's see if that is here. Yeah, that's the desired ending at the end of June. So we're using July information to plug in June. So we have cost of goods sold plus desired ending inventory minus beginning. All right, so beginning means at the end of any period, like this period's ending is next month, next period's beginning. So we can use April's ending as May's beginning, May's ending as June's beginning. But where are you going to find April's beginning? April's beginning would be 80% of April sales. I don't actually need March, so I'm going to use April's cost of goods sold, which is 46,500. Make it times 0.8. So it must have been left there at the end of last month, at the end of March, to be safe for April. So which is 37,200. Yeah, that's exactly what it is. So you have budgeted cost of goods sold plus desired ending minus beginning is your record purchases. So once you have the record purchases, just pay for it. They say, how's it paid? It's paid half in the month and half the following month. So disbursement will be just half of it. So like in April, we have total purchase of 49,500. Half of it divided by 2, 24,750 is paid in the month, within the month. And then another 24,750 will be paid the following month. In the same way, May is split between May and June is split between June and July. So there'll be 2 payments every month. Now what's paid in? How the March purchases were paid. We know March purchases because we know March's sales. March's actual sales was 46. So if March's sales is 46, 25% was markup, so times 0.75 was cost of goods sold, 34.5, and half of it must have not been paid. So 17,250 would be paid in the following month, and that's what it is. That's what is paid here. March purchases. What's March sales? Hang on, let me see. March sales are $46,000. So of which margin is 25, so times 0.75, that's March's cost of goods sold. Now cost of goods sold is not the same as purchases. That's important. So we need actually March row. Cost of goods sold is not the same as purchases. So let's find out March's. I had a March row. So March's cash sales and the March purchases. So March's cost of goods sold. $46,000 times 0.75, 34.5. Plus desired ending. Desired ending is March's desired ending is 80% of April's cost of goods sold. So April's cost of goods sold is 62,000 times 0.8. Sorry, 62,000 times 0.75 and times 0.8 would be the so that's 37.2. Minus beginning. So March's beginning would be 80% of March's own cost of goods sold. 34,500 times 0.8, which is 27.6. That's March's purchases. So 34.5 plus 37.2 minus 27.6. That's $44,100 is your purchases. March's purchases is 44,100, and half of 44,100 is 2250, and that's what is paid here. So March purchases are paid in March. Half of it was paid in March, and half is paid in April. So that's 22,050. Yeah, we have it. All right, so we are going to be able to be good. And then requirement 3 is the actual cash budget, cash beginning balance, so beginning cash balances and collections from that first requirement. Beginning balance plus cash collections gives you cash available, minus cash disbursements, so disbursement for inventory from the second requirement, like purchase budget, and then other expenses. So you don't just pay money for purchases of raw materials, you have labor, you have overhead, you have everything else. So the other expenses given here, and we know, for example, other expenses budget, for example, says other expenses include 12% of sales as commissions, so use that. 12% of sales plus rent of $1,900 plus 6% of sales with other expenses. So we have 12 plus 6 is 18% of sales So for example, how much would be other expense in April? 18% of what's April sales, 62. So $62,000 times 0.18 plus there's a dollar amount, $1,900 of rent. So 13,060 is other expenses. Yeah, that's exactly it is, what it is. So 13,060, that includes rent, sales commission, and other expenses of 6%. Remember, sales commission is 12%, other expenses of 6%. So 12 and 6 is 18% plus the rent. 18% of what? 18% of sales, the actual sales dollars. And then there are other occasions like during April, we're going to purchase an piece of equipment. So nothing else. And don't include any depreciation. So we have payment for purchases, payment for expenses like salaries and wages and rent, and then purchase of equipment. Incidentally, there was a cash purchase. So that gives us a total cash disbursement. Now there's a borrowing and repayment need. So at the end of, before you plug in borrowing, now see, you're like in April, you have 62,700 available, and you'd like to spend only 60,960, so you won't be short. So you can, it says excess of cash over disbursement 1,740, but they said that would need to maintain, the company wanted to maintain how much? Management would like to maintain a minimum of $4,000, and they can borrow in increments of 1,000, multiples of $1,000. So now I have my budget allows me about $1,740 of liquidity, like excess money in hand. So, but I needed 4,000. So 1,740. So 4,000 minus 1,740 gives you 2,260. So you're short $2,260 short. But you can't borrow 2,260. You'd have to borrow either 2,000 or 3,000. So this month you're going to borrow 3,000. All right. So that's our total financing. So $3,000 is borrowed, has been borrowed, plus 1,740 was already there. So that leaves us with a cash balance of 4,740. So we borrowed in April. Then we do the same in May. We have our collections, cash collections from requirement 1, cash payments from requirement 2, and the other expenses, 12%, 6%, and the $1,900 of rent payment. So those are the disbursements. And then looks like we're already short by $1,595. We needed $4,000. So you're already short by $1,595 plus 4,000 is $5,595. So you'd have to borrow $6,000. So borrow $6,000 and make sure that you have at least $4,000. So that's how May ended. We come to June, and here we have huge amount of money. We have 15,520 of surplus. We needed only 4, so we can pay off a lot. We had borrowed $9,000. We're going to pay off that $9,000 plus interest on those. So $3,000, you have to calculate 2 months of interest. Sorry, the borrowing occurs at the beginning of the month and payment occurs at the end of the month. So for the $3,000 that you borrowed in April, you have to pay April, May, and June's interest, like 3 months of interest. The $6,000 you borrowed in May, you pay only 2 months, May and June. So your total interest is $210. And after paying the 9,000, the borrowing and the interest, you still have a balance of 6,310. So your end of June balance is your end of the quarter balance. All right, take a look. You already have it. Then requirement 4 is the income statement. Sales minus cost of goods sold. Cost is the cost. So cost of goods sold has not been calculated. We have beginning inventory plus purchases. We know the purchases from the purchase budget minus ending inventory gives us cost of goods sold. And then we find the gross margin. Actually, there's a different way to verify, or you could, remember we had 25% markup. So if we have the sales information for the whole quarter, just take 75% of it, and there's going to be cost of goods sold. But that also matches to beginning inventory plus purchases minus ending inventory. So what I did, I just did, I don't know if you can see it. I just did 75% of the sales information, sales of $221,000, and I had my cost of goods sold. So that leaves me with gross margin minus commission 12%, rent $1,900 times 3, $5,700, depreciation, which is a non-cash one, but 918, I think. So 3 months makes it 2,754, and other expenses, that's 6% expense. Subtract that, you get net operating income and the $210 venture that you paid. So that's your net income. Account number 5 is your balance sheet. Cash balance is cash balance at the end of June or at the end of the quarter. Accounts receivable balance is only the uncollected portion of June sales, which is 36.8. And inventory is the finished goods inventory at the end of June. We know that from the budgets, purchase budget, and then because purchase budget would have used the beginning inventory plus purchases minus ending inventory. So we know the ending inventory from there. And then the current assets plus building and equipment, net and total assets. Liabilities, accounts payable, comes stock and retained earnings. All right. So some of the balance sheet information already here, like common stock $150,000 would not change. Accounts payable would have been paid off, but new accounts payable would be there. Building and equipment, we originally had $122,004, plus we purchased some equipment. Remember, I think $1,000, $1,100 worth of equipment. So add that minus the depreciation, $918 a month. For example, let me see if the building and equipment works. 122.4 plus 1,100 minus 918 times 3, 27.54. So building and equipment should be 127.46, and it is 127.46. So that matches. All right. Common stock is the same. Retained earnings should change because retained earnings beginning balance was 13,050 plus net income from the previous requirement, income statement 6,806 minus any dividend. Doesn't look like they paid any dividend. Minus 0 gives us retained earnings figure of 19,856. That's exactly what it is, 19,856. All right. So things are not bad, I can tell you. All right. So that's number 6. Number 7 is shorter. Yeah, it says prepare the company's budgeted balance sheet. Partial balance sheet is already given. Beginning cash is not, and retained earnings is not, but you should be able to work it out because we have assets. Write all your assets on one side and liabilities and equity on the other side. And it says the beginning balance of retained earnings was 33,000 plus net income, budgeted net income 17,005 minus dividends of 3,300. So beginning RE of 33,000 plus net income 17,500 minus dividend of 33. So that leaves us with retained earnings of 47.2, and that's exactly what you have here. Retained earnings of 47.2. See? Also, numbers are matching. This number 7. Take a look at number 8. Again, not a lot of requirement. Prepare the company's manufacturing overhead budget and the company's predetermined overhead rate. So manufacturing overhead budget, we have direct labor hours. Go slow, we have direct labor hours here. There's the allocation base. Multiply these hours by the variable rate of $5.75 per DLH. So multiply each of these numbers by $5.75 per direct labor hour. So that will give you the variable overhead plus fixed overhead is $78,000 per quarter. So put 78 in every quarter. So you'll have the total and they divided by number of hours. Hours are already given, 11,000, 9,700, and 10,000. And that will give you the hourly rate, predetermined overhead rate. Simple, isn't it? See the answers? DLH, budgeted DLH times 5.75 gives you the variable plus 78 gives you the total minus the depreciation gives you cash disbursements. But I don't worry about this yet. So the total manufacturing overhead of 141 to 250 is now going to be divided by the $1,100. See? So that gives us the hourly rate. And we already have a variable rate, $5.75. See? So the variable rate is $5.75, and the fixed manufacturing overhead, 78. So 78 divided by 11,000 plus manufacturing overhead budget for the overhead rate for the fiscal year, for the whole year, sorry. So the total manufacturing overhead, 550, 625 divided by hours, 41.5, 13.268. Yeah, 13.27. Yeah, that's what it is. So you got it right, yes. I was looking at it on a quarter-to-quarter basis. Well, so that's not too bad either. Just remember the hours times variable first. So that gives you the variable manufacturing overhead plus the fixed, which would be the same amount. That's the total. And then they wanted a total for the year. So you have 4 quarters, add all those 4 up. That's total for the year, then divided by yearly hourly rate. Number 9 is much easier. It says only the direct labor budget. So you have the units to be produced, and you know that each unit requires 0.35 hours. So multiply each of those by 0.35 and then pay them. So that would give you the hours, total hours worked, multiply them by $20. Pay the people $20 each. That would give you the budget. See, units times 0.35 gives the hours times 20. Easy. Finally, number 10, the last one. The requirement here is also simple. It's a cash budget. So we have the total cash receipts. Yeah, well, so it's simplified. It's much better than much shorter and simpler than the other cash budget that we did, because it gives us the cash receipts and disbursements. So we know that they also gave us the beginning cash balance. The company requires to maintain a minimum cash balance of $10,000 and may borrow same policy if they need at a quarterly rate of 3%. Company may borrow any amount at the beginning of any quarter and may repay its loans or in part of it at the end of the quarter. So borrowing happens at the beginning, payments happen at the end. Interest payments are due on any principal at the time it is paid. Assume no compounding. Well, so beginning cash balance plus cash receipts gives you cash available minus cash disbursements is estimated situation. So estimated deficiency here in the first quarter is 22, but they say you have to borrow 32. Borrowing happens. They can borrow any amount. All right. So they borrowed 32 to make sure that they're left with $10,000. So that's the expected beginning balance is 18,000 requires a minimum cash balance of 10. So if you have 22 short and you need to have $10,000, so you'd have to borrow 32. So you leave 10,000 with you. In the next month, or next quarter, you again have the beginning balance. So that 10,000 is your beginning balance for the next quarter, plus receipts minus disbursements gives you 120,000, a lot of money. Now you pay off 32,000 and the interest only. So interest at 3%, 32,000 times 0.03 is 960. That's your interest for each quarter. So 960 times 2 is 1,920. There's the cash balance. So there's the interest. So along with interest, we pay off 33,920, and we're still left with 86. Huge money. So that's beginning balance plus. All right. So that should be helpful, and that should be enough for us. So we have looked at all 10 problems that we asked you in the assignment for chapter 8. So I'd like you to watch the video, please, and go over the problems again. The numbers will change when you log in, but please try. Okay? Please try. I wish I could do one, I would go over all the problems of every chapter, but then there won't be much for you to do. Anyway, so I hope this has been useful, and I hope you enjoy or enjoyed. I mean, I'd like you to enjoy doing the assignments, no matter. I mean, it doesn't matter if you don't enjoy the video, but I'll see you in the next video. I hope you enjoyed, and thank you for your patience. Bye-bye.